Okay. Well, good morning and Happy New Year to all.
Yeah,
2021, can you see that, Mark?
I can see it.
All right. So 2021 was a lot like 2020. It was a year to forget in many ways from a health perspective, but from an asset perspective, it was another really strong year for asset owners. 2022, I think we're going to still see a lot of money flowing through the system and a lot of challenges on how we manage that money and where the opportunities are, because I think the grounds are shifting pretty rapidly right now. So I want to just take you through our thoughts on the environment and what's on people's minds. And then I want to talk about some of the risks that are in the system from a third-party perspective. And clearly the variants in the vaccines and daily living are first and foremost on people's minds right now. And how do we get through this? And Bill's done a great job of guiding us through it. We're at ARS of the camp that Omicron is rushing us to herd immunity, and that we are moving back to more normal pretty quickly, but you won't know until after the fact, but it feels like we might be reaching peaks in the US, and that would be a good thing. I think there are a lot of adjustments we're going to have to go through from a economic and social perspective to monetary and fiscal policy changes. I think the earnings outlook is really critical for what's on people's minds, as is the outlook for inflation. We think supply chains are getting resolved, and global stability is certainly top of mind for people, but these are the real issues. From our perspective, we think that the world's in a much more positive place than the headlines would lead you to believe. Whether that's for the pandemic or for the general economic activity, we think it's pretty much all the same. We think the global system has been particularly well supported because of all the stimulus that's been put out, which is why we've rebounded so strongly. We expect growth rates to continue to be up there, but we really think, and this is an important one, is we think that the inflation pressures are starting to abate and should be really coming down in the second half of the year. And the US is going to continue to be the driver of global growth, while China is focusing on stability, particularly around the Olympics and the next party Congress, as she's going for a third term. With that, rates are going to still remain historically low, and corporate earnings are going to be particularly strong, and that's going to be really the key element for it, but they're not going to be even in how it's dispersed. So, we think one of the big things that people are missing, and particularly in the media, is the massive amounts of stimulus that's been thrown at the problem. And if you just look, the US put over 57% of GDP from February of 20 to May of 2021 towards the problem. That's $12 trillion to solve a problem that was basically a 3% of global GDP, 3.5% of global GDP decline, or roughly, $3 trillion. We put in the US alone, 12 trillion to solve that. If you look at it globally, it's 30 trillion, but the US, Europe, and Japan have put massive stimulus into the system. And even though they're starting to taper and raise rates, that stimulus is going to be in place for at least another 12 to 18 months, which means we should continue to work through some of the problems and excesses as we go through this period. The other big element is corporate profits are still doing exceptionally well. And we're going to give you the reasons why we think the handoff is going on and why we think we're going to have a better year. But first, I want to touch on the risks that are out there. And I saw an interesting report from the Socroft Center for Strategy and Security, which is a nonpartisan group founded by General Brent Socroft, who is a Air Force general. He graduate of West Point in 1947. That was when actually the Air Force was created. He shifted over to the Air Force and had worked for two presidents as their national security advisor, Presidents Ford and the first President Bush. He's also been involved in virtually all policy decisions since the Vietnam War, working with various parts of government. He was involved with the Obama administration as well, and the Clinton administration. So he's been through a lot. This study comes out annually, and they looked at the top 12 risks for next year. And I want to go through them pretty quickly because they're not big surprises, but taken in total, they really require us to focus. So obviously the lack of effective vaccinations in developing countries is a problem. We saw that, how it took off in South Africa. It can create new variants that are potentially more dangerous and lethal, but as we're seeing maybe with Omicron, it may be more quick to spread, but not as lethal. So something to keep an eye on. Obviously, the Russia attacking Ukraine is a big issue and a big threat for next year. Not sure the win for that one for either side, because it would bring a lot of sanctions to Russia, but it would be devastating for Europe, and not a great spot for either side to be in, but certainly would be a major disruption to the global economy if they do continue to push in that area. I think the one that that they're focused on is China peaking and its economy sputtering, sparking global disruptions. That for ARS is not as big a concern. We think they're going to manage it well, and they're doing very targeted stimulus to work through that. But certainly something to keep an eye on is one of the drivers for the global economy for the last decade, and maybe the primary for the last 10 years, being China shifting to take a backseat to the US in global growth, I think is a key element to watch. We're not in the camp that they're going to sputter too much, particularly given the next 12 months and the importance to President Xi. Afghan collapsing and the US not being able to escape the consequences is a big one. And what we're looking at there is they have two issues that are really plaguing them right now. They have massive food problems for the country, and they have a banking system problem that they have to work through because people aren't clear on how to work with the Taliban due to the past sanctions. So that's something that we have to keep an eye on, and what that does to the region. Developing countries continuing to suffer more economic problems and having a rash of instability is a big one for us. We think that the imbalances between the global economy are severe and getting worse. And as the US does better, it's going to put more strain on the least stable countries. Oil topping $100 a barrel. And again, these are the soft crops risks, not ours. That would be very damaging to the global economy. It speaks to the fact that the energy transition to green energy was not as well thought out or as well planned. And you're seeing that now. Germany is decommissioning 3 of their 6 nuclear reactors at a time that they're having an energy crisis there with Russia. Some of the policy decisions need to be a little bit more flexible in our view to get through this, but that's why the risk of oil topping $100 a barrel exists. I think the big one, another big one, is the world failing to meet its climate goals. It was a pretty underwhelming output from the Glasgow summit. We have had carbon emissions go up 60% since the 1997 Kyoto summit. So we're not in great shape there, and clearly hard for struggling major economies like China to make a transition right now with some of the other economic problems. So we're going to have a continued issue with climate change. As a result of what's going on around the world, a bifurcated world emerges politically, but it's not a repeat of the Cold War, and that's mainly because of how advanced China's economy is. So you're going to have a kind of an East and a West potentially bifurcating. And it's going to be different because China is so much stronger economically and is coming from a position where they have a very strong financial balance sheet, although it's weakening lately. They do have big currency reserves, and the economy is doing generally pretty well, and they're very targeted in how they're going after it. This really gets to the tech world and how we're dealing in technology and trade as we go forward. And that's where the Cold War is going to be played out. Ironically, the reliances between the US and interdependencies of the US and China still remain great. So it's going to be interesting to see how that plays out. I think food security is a big one, and that creates a lot of issues, particularly as you're looking at failed states combined with food insecurity. And then you end up with a lot of migration at a time that countries are not in a positive state for that. So that creates more problems, as do failed states. And the list of potentially failed states is growing. And that leads to a whole series of issues as well. And it's all tied in. The nuclear deal with Iran doesn't work to get that revived. And that creates even further strains on the Iranian people and how do what autocratic regimes respond to those types of issues is usually with actions that create instability, that divert the attention from the problems inside the country. And then lastly, we've had a problem with democracy being challenged in the US for some time now. That is one of the items that they listed. From ARS's perspective, we're aware of those. We are focused on a lot of those issues. We don't hold the same views towards them, but we think you want to continue to focus on the stuff that's going to work, and the things that we talk about, whether it's the private or public markets, where technology investments driving productivity improvements are critical, particularly as demographics worsen. Data management and storage is going to only continue to grow, which means the cloud companies are going to continue to do well, which is one of the challenges for market participants. Is when you have Amazon, Google, and Microsoft dominating the cloud space in the Western world, and controlling all this data, what does that mean? And how do you transition from a handful of companies driving so much of the economic activity, particularly in the US? That's an area that we think is going to be slower to move away from the FANGs, and they're going to continue to do well, although they'll be under some pressure. Obviously, electric vehicles continues to become a bigger part of the conversation. And you just had, I think it was Delmer Mercedes came out with a 1,000-kilometer battery charge today. So they're continuing to push that out, which makes it more real. Defense companies in an unstable world are a theme we've had for some time. We think the world is getting less stable. Commodity and materials companies are not really for the drivers of growth or for global growth, just moving up overall, but more so about the specific uses of specific commodities and materials that are driving the technological change that are in short supply and not easily replaced. Obviously, biotech remains a big area for investment. Renewable and fossil fuel companies, we think, will both do well in this environment because there's so much money going towards one problem and away from another. The underinvestment will make fossil fuel companies perform particularly well. But you want to take advantage of the opportunities as they exist. Cybersecurity companies are obviously a big beneficiary of the bad actor states. And then cable providers are actually a big beneficiary of the shift to 5G. We think that's a big area, and Nitin's talked about this quite a bit. So overall, we think the global economy is going to continue to have a highly uneven recovery, with the US leading the way. China will continue to manage its economy to get steady growth without disrupting their own goals and aspirations, but they are doing it in a very targeted fashion, very different from the Western world, who are throwing massive amounts of money at big problems. They're taking a very targeted approach to how they're approaching becoming a less export reliant economy. We think the deflationary pressures will reemerge in the second half of next year. The tendencies to the economy towards deflation will reemerge. And we think that the only area that's under pressure for deflation expectations from the big four, which are tech advances, demographics, debt, and globalization, is globalization's wobbling a little bit. We think the balance sheet expansion is going to be very difficult to unwind, which means we're going to have a highly liquid economy, global economy, for some time. And then lastly, we think that climate change continues and that earnings are going to be the driver, and it's going to be about earnings, not multiple expansion. And the last thing I would say is the big change that's going to occur next year is the handoff from government policy to consumers and corporations. Consumer spending on services shifting from goods, and corporations spending on productivity. And that's going to carry the ball moving forward and creates what we think is a positive environment. Don't get sucked into the headlines. I'll stop there, Mark, and turn it over to Bill. I don't know how you want to do questions now or questions after Bill goes.
Yeah, well, let's do some questions here, and there's some things that relate to what Bill's going to talk about shortly. But questions, thoughts on what Stephen just presented?
Stephen, the Scowcroft.
I see, Adam, you're trying to vie for the award next year for the first question with Rob Colorina. You were really differential last time, but now you're stepping out.
I made a New Year's resolution. I'm going nuclear.
Okay, go.
The Scowcroft report, in those failed states, did they detail the states who in concentration failed states? Just out of
Yeah.
curiosity, if you.
Yeah, the usual cast of characters are always on the list, the Somalias and the
Right.
Yemens and the like, but it really goes back to the big ones in the Middle East that they're worried about still remain Syria, Afghanistan, and Lebanon. Those areas are still really unstable, and they're causing great concern as that pushes into more migration into Europe at a time that Europe doesn't want it, and it's creating more strains. So they did talk about it in detail, but there weren't any big surprises there.
Was Turkey in not a failed state, but was there discussion of concern regarding Turkey?
There's concern regarding Turkey for instability, but not necessarily for the failed state.
Right. Okay. Thank you.
You're welcome.
There's a question, I think posted by Simon, but Steve, my interim quick question: how come Scowcroft is so concerned with Afghanistan, just given the withdrawal that we've had? It seems like that was part of the the policy hedge and economic hedge taken, but despite the withdrawal, that ranks pretty high in terms of some sort of economic impact.
Yeah, I think the issue is really around two things. It's around terrorism. For one, does it become a fertile ground for terrorist activity again? And then the second element is who is going to influence the area for their resources that they have. And, is China going to step in and become a bigger player there, as they tend to go to the places that the US has left? And what does that mean? So I think that creates a policy issue for the US as to, if we mess it up, do we have to go back in and fix it? And if we don't, who does, and what happens? And is it fixable? But I think there's a lot of natural resources there, particularly around rare earths, that are attractive to people. And then there's the other element of, the drug trade and others. So it's a lot of elements to it that create some problems around that.
But Stephen, that would be more of a migration issue and policy issues for Russia and China than the United States.
Yeah, I don't know. It depends on where they go and then what's our response to it. So it wouldn't be it's not one of my primary concerns. And Adam, ironically, they left off inflation as one of their top 12, which I was interested to see that on investors' minds, I think inflation would be in the top 2 right now, and it wasn't in their 12 items. So I thought that was interesting as well.
Other questions, comments? Nick Kroll, you wanted to make a comment in the chat about the lack of coverage of China, Hong Kong? You're on mute.
My group, Metal International, I heard a comment about basically 20 million people lost their democracy in Hong Kong with China overtaking it, and there was no real publication of that. Just something I thought might be worth mentioning to the group.
Yeah, that's an interesting one. There was a really interesting article I read last night. I'll have to try and find it. That was the most negative article I've seen on President Xi and where he's taking China and what it means for China that I've seen in some time. And it gives you the sense that his ability to control the economy, the country, the way it had been in the past is actually improved, but also worsened because of technology. And what does that mean to rights, and where does that go? It's a major issue that China is going to loom large on the stage for all elements, social, economic, and political, for some time. So that is a big issue, and that's one of the issues that is getting a lot more press now, is companies and governments are hesitant to go after China too hard for their abuses. So what's that going to do to empower Xi? And I think that is an issue that is going to be a problem for some.
Also, what about the human rights topics with the Olympics? Do you think that's going to be a big factor or not so much?
Not for advertisers. They're not going to be saying anything on it. And they're not going to pull out at this point, I don't believe. So I think there'll be protests, and I think the world is going to try and look past it, unfortunately.
People should remember, hi, Stephen, good to see you. Thank you. As always, this is excellent. Unfortunately, I agree with you on almost every point. So I don't have anything really to add, other than the fact that we should remember that Putin annexed the Crimea only days after the end of the Sochi Olympics. So once the big group hug ends, I would not be surprised.
They arguably attacked Georgia during an Olympics, or were provoked during Olympics.
Yeah, Andrew, the only thing I would say is he may push it off till after October when they have their party Congress, so he gets his third term or president for life that he's targeting, which seems to be a done deal, but I think he may want to wait before he takes more aggressive action after that.
You know, one thing I've been reading more and more, and there was a great article in Foreign Affairs 2 issues ago about this, is that let's say that she does do a harsher clampdown on Hong Kong or does something to provoke some form of action on Taiwan. We are essentially militarily powerless to do anything and politically powerless to do anything. The only levers we have are corporate levers, because leaders like she don't really care anymore about global public opinion.
Yeah, we're also going through a major modernization and upgrade of our armaments because we depleted them so much over the last 20 years. And, you know, Russia and China have been really ramping up their high-tech weaponry, and we're not as far along as we need to be there. So it's not great timing for us.
I can't find it so quickly, but it was one of the predictions from last year was that China would take over Taiwan. That was from, I'll just show you, Rob Garrett. I'll probably not have it right, but
young men and women who served in the armed forces of many nations, not least the US.
I can only get so lucky, but that's my plug for doing your predictions. There are, you can see all the videos in our playlist. I think we have 65 from last year, and we'll start populating them for 2022. Deadline January 14th. Other questions, comments before we go to the Fed?
Yeah, quick question, Luke here. Great job, Stephen. I'm surprised that if what the gentleman said about I think it was Nick about Hong Kong and China. I know Biden has stated that if China does the same thing with Taiwan, that they would respond. So why Taiwan versus Hong Kong, which Hong Kong and Taiwan are the two powerhouses for the Asian kind of liberated economy from the Chinese kind of way of doing business?
I can't answer that, Luke.
Look, because Hong Kong is a territory of China, officially recognized, and Taiwan is not officially recognized. That would be my guess. In general, like Steve, thanks very much for putting together this global picture. I'll just make a few comments on the emerging markets. My feeling is that, and those of you who heard my comments before, nothing changed, just the situation progressed. Basically, Putin is, the person who crushes U.S. sovereignty, U.S. reputation in the world, and does it very effectively. And he basically lays the rails for the Chinese to misbehave. And that's why that was my thesis, hypothesis, let's say, in 2019-20, and now we see that the Chinese are doing exactly what the Russians did. The Russians misbehaved in Ukraine, and the Chinese are doing this in Taiwan. And unfortunately, our leadership provoked Russia in the case of Ukraine, and now we don't know how to stop Russia, and we don't know how to stop China. And of course, nobody particularly knows why we need Ukraine, but everybody knows why we need Taiwan, right? And unfortunately, the situation is progressing in the wrong direction, with us not being able to put anything on the ground. If we were serious about China and Taiwan, we would be serious about Ukraine, because realistically, if we put troops on the border with Ukraine, the Chinese would understand that we would do something about Taiwan. But if we don't do something in Ukraine, and we don't need much in Ukraine, then guess what? We don't need much because at least our allies are there, right? Guess what we can do in Taiwan, where we have Japan, which will not go to war with China. So realistically, I think that the way we're behaving now, signaling globally, is that we're not going to defend anyone.
That goes back to Rob Colorina's part of it, or someone's point about Afghanistan.
Right.
Putin watched that very carefully.
Yeah, and Putin kind of showed to the Afghans that if they don't do anything against the republics, the stans there, like Tajikistan, blah, blah, he's not going to do anything to Taliban, even though Taliban is labeled as a terrorist organization in Russia, just as ISIS was. So they're at the same level. Every time a Russian newspaper or news agency mentions Taliban, they have this. They have the follow-up statement that it's a terrorist organization by the Russian designation. So it's definitely not a friendship there by no means. But you know, they're much more flexible in their policies than we seem to be. And then when you're talking about the possibility, the likelihood of all these outcomes, I still believe that they are very low. We're kind of fascinated with this end of the world scenario, but one would think that it is an end of the world scenario if Russia occupies an additional part of Ukraine, and even worse if the Chinese become more aggressive against Taiwan, because in the case of Russia, okay, Europe will end up without gas, but nobody else will notice it otherwise. In the case of Taiwan, that basically means that we will sever all economic relationships with China. Then for both countries, it will be terrible. So there is a limit to the bad scenarios that I see, at least I see. Thank you.
What I thought it was interesting, people who live in Singapore have a little different perspective. This is where Rob Colorina, or Rob Garrett, from it was April last year.
Taiwan to be taken by stealth by China in the next 2-3 years, and they're probably hoping for some kind of distraction tactic to come out of
Ukraine.
Ukraine or somewhere where Russia will distract Western powers, enabling China to take Taiwan by stealth. But that all comes down to how much of a conspiracy theorist you are. Fundamentally, I'm just focusing in on those three things: healthcare, climate.
So, interesting perspective. We should move on, and we have our friend Bill Deuchler. And if you don't know, every week he presents to his principal, and then he presents to us. I don't know what order. Usually, I think we're second. So maybe you could tell us about QE events and Fed decisions and market responses. But should I hand the reins back over to you? Do you want to do your own slides, Bill?
You know what? Why don't you go ahead and push the button for me if you would.
Can you see that okay? Market response, is that on?
Yeah.
Yes.
There we go. Sounds good. So yeah, thanks. Happy New Year to everyone. How quickly we forget that we've just gone through the holiday season. But it's last, the Fed announced like back in November that they were going to start to taper, and then really put the exclamation point on it on the December 15th press conference with Powell. And there was a lot of concern about, how is the market going to react? Was it going to be adverse, whatever? So, I thought it would be educational to kind of take a look and see what actually did happen over the course of the history of QE events, and how the market responded. And I think, this slide right here is pretty interesting. Essentially, it's a one-way elevator, on the way up. And I've put down as many of the QE related events as I could without completely cluttering things. But you can see, there's a lot that was going on over the course, from 2008 when QE1 was first announced. We had the tapering, the twists, normalization, which is the Fed replacing the bonds on their balance sheet, and to the degree that they refund those, and then in January of 18 they said, well, we'll have the option of doing it or not. So that's kind of what all that means. So let's go to the next slide, please. So let's take a look what actually did happen in the market, specifically with regard to the S&P after QE1, after QE2, Operation Twist, the taper tantrum, and the end of QE3. So here's a spaghetti chart that rebases the S&P price performance starting at the day when those events happened, i.e. the end of the QE programs. And you can see generally that it was more or less benign. Interestingly enough, the end of Operation Twist, which is the green line, was the best performance of the S&P following the end of Twist. And the worst one was at the end of QE1. But overall, after 180 trading days, which essentially is not quite 2/3 of a year, the market was up after all that, which I think, sometimes people don't think that was the way it was. And the temper tantrum, which is shown there in pink, the worst of it was just in the first 30 days. And I think if people recall, that was when Bernanke sort of dropped it on the market in the midst of congressional testimony. And I believe it was actually a response to a question. It wasn't even embedded in his official testimony. So that really spooked the markets, and hence the sell-off there. So if you want to go to the next slide. Another thing that some people ask about is well, what about 2018? Wasn't there a temper tantrum, then? And I think it's difficult to come to a decisive conclusion that the Fed, rate hike, right there in at the end of September was the causal factor, for the decline in the equity market. I put together a timeline, which is shown there on the left-hand side of the chart, that there's just a lot of things that were going on. QE3 had ended, towards the end of 2014, which was like 4 years previously. There were 9 rate hikes leading into that decline. There was a lot of things going on with the Trump administration at that point. Tariffs were being put on China. There was a lot of concern about growth outlook going forward. The Brexit, how quickly we forget. Brexit had one of the latter reconciliation proposals failed. So there were just all kinds of things, not the least of which, with the midterms that switched from kind of the strong Republican dominance, to having Democrats come in. So I think it ended certainly, with a blast, with the worst Christmas Eve stock performance on record. And overall, top to bottom, that sell-off was almost 20%. which is nothing to sneeze at. But at the end of the year, 2018 in total was down about 5. So you can see that that last downturn took all the positive performance of the year and then some into the cellar. But but again, it's really hard to pin all that on that 922 25 basis point rate hike, the Fed. So if you want to go to the next slide, please. So I wanted to take a look and say, well, what could potentially be expectations for going forward? And to do that, I created just some bands of a hypothetical envelope of S&P performance. And what I did was I took what are the best days of that spaghetti chart that I showed, a couple of slides back. That's the green line. And then what are the worst days, which are the red line? And then take the average of the performance of that whole spaghetti chart. Yeah, there you go. Thanks, Mark. So, and this is what your envelope looks like. And the kind of the cumulative returns after 180 days is that the green line will give you about a 6% return. The average is about 3.5%, and the worst is still positive. It's still positive at about 1.5%. So in terms of going forward, and this is like taking it as of December 15th, what could potentially things look like? And again, this is pretty focused, just on the performance of following these events. So who knows what else will influence it? But if you want to go to the next slide, so I updated my forecast after not quite a month. And you can see, there's the envelope of the potential outcomes. And then the gold line is what's happened since the 15th of December. And interestingly enough, already I've been right and I've been wrong several times on both sides. We've pierced the lower bound in terms of, potential worst trace, and we've exceeded the upper bound. So the market's been doing the market, and so far we're there. But I think in general, just kind of looking at this, I hope puts it in perspective for people and gives you some channel by which you can kind of continue to follow the market, based on what has happened in the past. So
Bill,
there we go.
I'm going to beat Adam and Rob to the first question. I'd be curious on the green, the blue, and the red, but I guess back here, 2 slides back, what the the past 180 days before those lines looked like. Just maybe that's something an ask.
Sure.
We could.
Yeah. Well, actually, yeah, Mark, if you want to back it up, to kind of like the first slide with all the events. There you go.
Yeah. True.
Yeah. You can see. Really, since 2009, the market has been on a sustained upward trend, albeit with volatility, but the trend has definitely been upward, and it's only been punctuated with a few drops. For the most part, we really haven't seen a lot of time in negative territory in the market, which is quite remarkable. Now, obviously COVID, was like, that was taking your breath away. And was that going to last? Well, fortunately it didn't. Back in 18, and then, again, 18, because of that 20% drop right at the end of the year, turned out to be a negative year. But for the most part, 2018 was up. It was just at the very end that the market dropped and took away that positive return. So, I think that it goes back to a lot of what Stephen has been telling us, in the sense that, we just have a very strong economy here in the U.S. and it recovered very well after the great financial crisis. You can't discount the impact of QE, and particularly now with the fiscal stimulus coming in. It's always been monetary before. Now we've got fiscal stimulus added to the mix, and that's really supercharged the market. So, or the economy. and that's been translated into good performance in the stock market. So it's kind of a long answer to your question.
Bill, the other thing on that is the start of tapering is still accommodation, it's not tightening. It's you're still putting money into the system. So we're doing 90 billion this month, 60 billion next month, and 30 billion the month after. That's all going into the system of new money. So the idea that tapering should slow the economy down when you're still adding money in it is what I think trips people up, which is why even when they start raising rates, the economy's still stimulated enough that it can carry through for another 12 months or 18 months typically. So that's what people get wrong. It's usually at the end of the rate increases that you start to see the market declines, not at the start of them. I think that's when people get thrown off.
Yeah. It's certainly a second derivative, situation at the moment. And actually, Mark, can you advance to the spaghetti chart again?
Sure. I was just a little distracted by it looked like Eddie was walking into a cornfield.
Okay. So yeah, you can, and I think, kind of Stephen, to your point, you can sort of see that with each one of those lines, right after the end of those QE events, you can see that the lines tend to sort of drop down, albeit, maybe for not that long, but they, for the most part, they do. You can see the pink, the blue, QE1 obviously was the worst performance. It took, almost 130 days before it got back to the initial level of the S&P on that one. So there is, some negative territory that's probably going to be traversed. The other thing is that, overall, although these, after 180 days, all these lines end up positive, it's not huge, and maybe we've just been conditioned by these last couple of years of, very stellar, equity market returns. But they are positive, but they're not huge. So, and there's a lot of volatility between here and there.
Other comments, questions?
Yeah, Andrew Randak here again. Question for both Stephen and Bill. A lot of people are talking about a forthcoming fiscal drag on the GDP calculation and how it is constructed. Do you guys take that into consideration going forward? 2022 could be, some people are saying -6%, -5% of GDP.
Wow.
We're thinking the handoff is what's going to matter. The handoff to consumers and to corporations, because there's so much cash in the system that the government's slowing down what they're doing can easily be picked up by the consumers in the U.S.
Okay, and I apologize. That -5, -6 was a contribution, not a total number.
Right. So I think you have such a powerful setup for consumers and corporations to invest and spend. Investment for productivity. You're going to see robotics pick up so fast in a lot of the retailers and other areas that we're going to offset some of the inflationary pressures with it. I think that's going to be a big driver.
Yeah.
Go ahead, Bill.
I'm sorry. There's also, there is so much cash on the sidelines. It's not, it's absolutely crazy. The one caveat to that, though, is that if you look at the margin account figures, it is people have leveraged themselves in margin accounts to a degree that has never been seen before that statistic got started being counted. So, we are worse than 2007. We are worse than 2000, with the .com. It's darn scary in terms of what's going on the retail side. So that's one caveat to it. But at the same time, I think that we absolutely can't ignore the amount of cash that's sitting on corporate balance sheets that's out there, and even in retirement and foundation and endowment portfolios as well.
That's a great point, Bill. The consumer net worth number is now over $150 trillion for the US, which is up from, I think, 100 2 years ago. So massive increase in net worth, which changes people's confidence completely. And even for not the wealthiest, but for the average consumer who owns a home, their home value increases or drive a lot of that confidence as well. So you have consumers much more confident and corporations flush with cash. That puts them in a really interesting spot to do a lot of spending and still see the earnings rise. And I think that's really going to be the driver for where you want to invest. But because of what Bill said, you also know that there's going to be a lot of volatility because whenever you have this much debt in the system, blowups happen. And you're seeing it in China, you'll see it in pockets in the US as well, and you'll see it in a lot of the emerging economies.
Yeah, and I completely agree with both Bill and Stephen. One thing which I just wanted to add to what Bill said in describing the situation in 2018, there was this disbelief that the market was going up nonstop since the moment President Trump was elected. And many people in the hedge fund community really didn't see any fundamentals to support it, to support this appreciation. And at the same time, there was a huge leverage in the system. And I remember everybody to whom you would speak would tell you that he sold puts because the market was flush with liquidity, and on and on and on, and the interest rates will not do anything. And then suddenly the market started going through the put strikes and accelerated on the way down, and pain was enormous. But it all started, I think, with the disbelief in the fundamentals of the market. Thanks.
No, so Simon, I think that's a great point. And I think on a go-forward basis, one thing that we ought to continue to keep our eye on is investor confidence and consumer confidence, because investor psychology is what really is going to drive the marketplace. And if we see any cracks in that, and any number of factors, Stephen just touched on the geopolitical thing, but there are so many landmines out there, and if something happens in that sphere, you could see a flashpoint. You could see confidence break there. Hopefully we're on the other side of the COVID thing. If something happens there, another bear trap could come out. It's just so critical that investors continue to remain confident in things. And Simon, we can traverse a lot of rough ground if people have confidence going forward. If they don't, then look out below.
Bill, that's a great point, because the Bloomberg had an article that 72% of CEOs are concerned about their job security going into this year. So they're not starting from a position of confidence there either. But the ones who are confident because they made the investments to position themselves well going forward. And the ones that I imagine most of those 72 are the ones who are highly indebted and having low growth and not very confident that they'll navigate this. So I think their confidence is a key element for both corporations and consumers. But I think you have such divergent starting points for the haves and have-nots that's going to continue to play out. And it's going to be something we do have to keep an eye on.
Hey, Bill, it seems like you did some pretty good policy dives here. He didn't seem to bring up digital assets or crypto very much, and I don't think I saw that on Steve's, sort of 8-sector top list. Can you just give some color on that, or what your observations are?
Stephen and I are arm wrestling on the pause there. It's like who's gonna dive in first. So yeah, it's really interesting, because when you look at Bitcoin and you look at Ethereum, kind of the two quote market leaders, Bitcoin was only up like 53% this year, just despite the volatility. Here's some interesting fun facts. the price range on Ethereum this year was $3,000. So if you had invested at the beginning of the year in Ethereum, you would be up fourfold, 4x by this time this year, even though we've come off the highs. So it's absolutely crazy in terms of what's going on. I think that if you were to ask people kind of where we are, in the Bitcoin cycle, we've probably fallen back into an accumulation phase. Some of the people who I follow, have a very interesting methodology of looking at logarithmic fittings of highs and lows, and we're kind of square in the middle of the channel between the high and the low band. There's sort of a no man's land in between there, which generally tends to indicate that there's an accumulation phase going on. So I think and if you look at just some of the chatter, before when we were at like 65, 69,000 on Bitcoin, people were going, oh, 150, 250, 350, what's your best guess? Now people are saying, well, are we gonna go back to 60 or are we gonna go down to 30? And it's, you want to talk about manic psychology, in the crypto space, it's like all over the map. But I think that we're still going to continue to see, progress there. One thing that's really interesting that I think is very much underneath the radar, unless you're in the space, and I'm not claiming to be there, but there are other people who certainly are, much more than me. There are coins, like legitimate projects, that have done in the thousands of percent for last year. It's absolutely nuts. And, there are some crazy things like Dogecoin, which I think was up something like 2,900%, something nuts though, like that.
I just, I'm sorry, I'm crypto skeptic here.
Yeah.
The drivers and the manipulation and the ability to manipulate and influence all that is so unclear.
Yes.
And they're maybe crypto liquid. Those who want to counter me, I'm happy, but I'm worried because we got to transition in 3 minutes to Jack Klein.
Okay.
But
Yeah.
Is it time to do another crypto? If you looked at those predictions, people were making Bitcoin predictions all over the place. On what?
Right. Well, there are, yeah, Joseph, I'm with you on that. So, it's all over the map. It's going to continue to be all over the map because we are still really early on in the space. This is just, as I tell people, this isn't like the first or the second inning. They have not even built the ballpark yet. We're that early, even though for some folks who've been in it seems like a long time. There are a lot of different arguments. If you want to talk about deflation, inflation, if you want to talk about percentage of the global monetary base, you can make a claim for Bitcoin going to like 350,000 if it gets, I think, to like 3% of the global monetary base. Now that's based on a lot of adoption happening, but it is, now it's crazy. When I've been to a couple other family office conferences, there was one where crypto assets was the opening keynote. It's
they paid for it, Bill.
Well, yeah, but they didn't.
They paid for it all over the place, and Tether and all these other things that are happening. I don't care if institutional investors are putting 1-2%. They're going to regret it.
Well,
they could potentially regret it. Show me the business case. Now, with that question, I will unfairly cut off the discussion.
Okay, can I just say?
I feel like the McLaughlin group. Here.
5 seconds.
Yes, sir.
Some of these projects are legitimate efforts to solve serious business problems.
On the program, let's start with that startling figure.
And that's the thing. Those are the projects that you want to watch.
Well,
that have
real.
Yeah,
to what you're saying, Bill, some are like regular tech startups, but they use coins or crypto to fund themselves.
Yep.
But they still benefit from the valuations that the brand name cryptos have and the liquidity there. But you at least have a hedge. Like if anything crashes, you have a business under.
Yeah, absolutely. Absolutely.